somewhere between $6,000 to $8,000 on the gold price, hopefully a few years from now. There is a long shot case that this could be the big reset for gold as a monetary instrument. And in that case, talking about a gold price much higher, over $20,000, has gone from a tinfoil investment to a TINA investment. There is no alternative investment. Portfolio managers are realizing that they have to have a significant percentage of their portfolio, saying it should be 20%. Silver has outperformed gold in every long-term monetarily based bull market. Going to do that again.
Brien Lundin, editor of the goldnewsletter.com, as well as host of the New Orleans Investment Conference. It's a true pleasure to host you on Palisades Gold Radio today.
Yes, great to be here. Thank you so much.
Brien, how can I start this conversation any other way than asking a question about the gold? And more specifically, we've seen an increase in volatility recently and a bit of a drawdown. Is this gold bull market still ongoing?
Yeah, it is. The fundamental factors driving it are the same. I started off one of my recent market commentaries to my readers saying, welcome back, volatility, my old friend. It is something we have not really experienced much in this bull market that began, late February, March of 2024. We have had, rather than the typical corrections that you would have in a bull market, we've merely had sideways trading ranges for a while before the gold bull market reasserted itself with very strong upward rallies, upward pulses. The one exception being the U.S. presidential election last November, where we did have a correction, but we quickly rebounded from that. I think that's what we're going to see again. Gold did get overheated. It became a bit of a momentum trade for the first time in this bull market. We saw that through the inflows into GLD, the physical gold or paper physical gold ETF. But we've also started to see Western investors finally get involved in the mining stocks as well. So I think that's just par for the course. This is the first correction, if you will, a pause that we've seen in this bull market that has come after Western investors have gotten significantly involved. So it's been more abrupt than what we've had before, but I think central banks are still buying. Those fundamental factors are in place. The debasement trade, as Wall Street has come to label this, is still firmly in place, and that's a function of the mounting debts that we've had after over 4 decades of ever easier money and ever greater debt accumulation. So those debt loads have not gone away. If anything, they've only accelerated in their growth curves. So yeah, all the fundamental factors are still in place. We are going to get through this correction, I think, very shortly. And whether we begin another big rally or just trade sideways for a while, I don't think this bull market is in danger of ending at this point.
I thought you would say something along those lines, Brien. And of course, if you look at historical parallels, previous bull markets have had drawdowns that were quite substantial as well. So perhaps one should be patient in a bull market like this.
Yeah, I think this is a secular bull market, a major bull market. And, it seems counterintuitive, but this 4,000 or 5,000 year old asset called gold has only had, to my count, 4 bull markets as an investable asset. I divide it into the early 70s, the late 70s, the 2000s, and the current bull market. Each of those bull markets was multi-year in length, and this one really just has gotten started. So I think this is one of those markets where we're looking for a number of years, hopefully a number of years. And I think the end game, the end point, if you judge by past bull markets, is somewhere between $6,000 to $8,000 on the gold price, hopefully a few years from now. at least. But I think that's where it's headed. The timing's always tough, but I think that the trend is clear and the endpoint is roughly in that area. Now there is a long shot case that this could be the big reset for gold as a monetary instrument. And in that case, to back the amount of fiat currency out there, we're talking about a gold price much higher, over $20,000. So, whether that happens or not, who knows? But I think we just need to see the trend, the long-term trend, recognize that, invest accordingly, and not get shaken out during these corrections that I think at this point are going to be more typical in nature. Rather than just trading ranges, I think we're actually going to see 5, 10, 15% drawdowns along the way.
Interesting that you say that this revaluation case is a long shot chance to go significantly higher in the gold price. If you look at the incentives of a government, every government around the world seems to be laden with government debt. High debt to GDP is above 100%. You would think their incentives are to increase the gold price to clean up their balance sheets.
Yeah, to some degree. I mean, it can technically clean up a balance sheet if their gold reserves are revalued. But that's the balance sheet. That's not the debt. That doesn't affect the debt unless they sell their gold, which is counterintuitive and counterpurpose. So that I don't think is going to happen. Yes, they can revalue it. They can make things look better. They can dress it up, but the debt is still there. And making the balance sheet look better only allows you to borrow more and, in the long term, accelerate that trend. So I don't, I think there's a chance and I get to that point by, I'm looking at $6,000 to $8,000 gold as the most likely target for the price in this bull market, because those 3 previous bull markets that I mentioned, the gold price went up 5.6 times, 8.2 times, and 7.9 times from the bottoms, from trough to peak. Those were the gains. If you mark this bottom at around $1,050, then you get to $6,000 to $8,000. Now, if you take the 1970s as one big bull market, then you get a multiple closer to 24 times, and that's how you get over $20,000. I think that kind of a move would probably require some kind of an official gold remonetization, but it doesn't really have to be official. It can be unofficial. It can be a recognition by the market that this is the amount of currency out there, this is the amount of debt out there, and therefore this is the valid price of gold as measured in those depreciating currencies. So it can happen officially or unofficially. But I think it's a possibility, whether it's a de facto or a de jure recognition of gold as money. I think that's what's happening right now.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Does that revaluation need to come from the US or even the West? Could also a different party do it and through that revalue gold for everyone around the globe?
Yeah, you could have the BRICS revalue gold, and then the dollar is a trade currency relative to those trade currencies. But I don't think, I've never been a big proponent of the dollar losing its reserve currency status at any, in any time frame that matters to, anyone of my age, anyone of your age actually as well. I don't think it's going to happen anytime soon because of the rule of law. The U.S. Rule of law has a lot of reasons to criticize it, but I think it's still the best in the world. and money goes where it's going to be treated best or much more certainly. And I think the U.S. still has that status and will for a long time, as well as all of the debt that's denominated in dollars. Still, you have to recognize the trend, and the trend is for the dollar losing, or its status as the world's reserve currency being degraded on a regular basis, and in a trend. And you see that it's losing its status as a reserve currency, not to the euro, not to the yuan, and not to the ruble or anything else except for gold. That is the money that is replacing the dollar. The gold's percentage as global reserve currencies is rising, partly because central banks are buying it, and partly because it's increasing in value. Since this trend started of central banks buying gold, the price of gold has essentially doubled. So wherever it was before, if they hadn't bought a single ounce of gold, then its level would have doubled as a percentage of their holdings. But you add on to the fact that they are actually buying a lot of gold, and the growth factor is compounding.
Understood that revaluation trade is a long shot, even though it is a possibility. What about the liquidity sink argument that governments around the world are using gold as a place to slosh liquidity, access liquidity in the system towards?
Well, yeah, there's a lot of money been created over not just since COVID, but really since the great financial crisis of 2008. All of those trends that had been in place for decades accelerated with that, and they're still growing. So a lot of money just sloshing around the world. And as much as central banks say that they are sterilizing the money that they're creating, the debt that they're creating, by absorbing it onto their central bank balance sheets, it really, yes, that's happening, but that money as debt paid for something. It has already traveled through the global economies, had its multiplier effect, bred more currency along the way before it could possibly be sterilized. So there are oceans of liquidity just sloshing around the world in the investment markets as well, searching for what the latest thematic investment from AI, from Mag 7, from crypto. They're looking for anything, any place to be. I've been remarking that gold in particular over the last few months really has gone from a tinfoil investment to a TINA investment. There is no alternative investment. And that's what we've seen, that portfolio managers are realizing that they have to have a significant percentage of their portfolios, some allocation to gold in their portfolios. And that percentage is, by the actual numbers that they work on, by modern portfolio theory, that percentage of gold allocation has risen from 5% to 10%. And now you see big time money managers saying it should be 20%. If that happens, if that becomes, the best practices for big portfolios, you're going to have tremendous amounts of that global liquidity focused into a very tiny market, and the results will be even more explosive. In fact, much more explosive than what we've seen already.
TINA, there is no alternative. That's a new one for me. Love it. Talking about a generalist investor for a second, it sounds like then for them, as long as they're patient, it's not too late to acquire some bullion.
Yeah, I think you need to look at why you're buying bullion, why you're buying gold or silver. There are really two reasons to own gold and silver. One is as insurance, and the other is as investment. If you're buying for investment, you're looking at the macro trend, arguing for one of those big catch-up periods for gold and silver, which you see as the big uptrends along the long-term line. We're seeing that right now, so I firmly believe it's a great time to invest. But given the moves that we've seen in gold and silver, maybe bullion is not the place to be, but in the leveraged investments, which actually silver is one of those, is playing catch up right now in mining stocks, which are trying to just starting to play catch up right now, and even after their tremendous moves so far, still remain undervalued relative to the gold price. The other reason that I mentioned about to own gold is as insurance. And if you look at the long sweep of history, gold has always protected investors and savers from the depreciation, the inevitable depreciation of their currencies. That is something that's going to happen again. And from that standpoint, it's not whether you can afford to buy gold at these prices, it's whether you can afford not to. Because again, that debasement trade, as Wall Street and the mainstream financial media have chosen to meme this trend, that is real. That is going to happen. They are just starting to recognize that these debt loads mean that currencies have to be much more rapidly depreciated. And from that standpoint, investors and savers can't afford not to own gold, even by purchasing that insurance at these prices.
Thank you, Brien, for sharing those insights there. I would love to transition to the miners, which you already, of course, started doing. You mentioned that they are still incredibly undervalued at current prices. Perhaps you can explain to us how that can be even after those very explosive moves. Is that because they have increased less than the value of their assets have due to that leverage effect?
Yeah, and we're going to be awakened to that fact very shortly when the big miners start to report that as quickly as the gold price has risen, as quickly as the gold equities, the gold producers' share prices have risen, they still have not kept pace with the earnings at these gold prices. Every gold project in the world, every producing project, every project that was marketed as being out of the money, not developed, and as an optionality play, all of those projects are not only economic, but robustly economic at these levels. And we're about to see tremendous earnings from the gold producers over the next few days and couple of weeks, in fact. So I think that point, that they remain undervalued on a price to earnings basis, price to net asset value, et cetera, that these gold miners remain significantly undervalued. That point is going to be driven home very shortly. If you go further down the food chain into the developers, you see that big gold projects that were 6 months ago valued at $10 an ounce in the ground are now valued at $30, $40 an ounce in the ground. They are still undervalued when those kinds of projects have historically sold for $150 an ounce in the ground in a normal market, much less one as fevered as this one. So in these kinds of markets, if we get the M&A going, as we've seen in the past, those kinds of projects could be selling for hundreds of dollars an ounce in the ground. So these developers still remain largely undervalued. On the exploration standpoint, the companies that were, $5 to $10 million market cap are really good exploration projects, but not a whole lot of money in the bank. They've got a lot of money in the bank, and they're valued at $20 to $30 million, which is kind of an historic average. So, across the board, the potential leverage of mining equities across the food chain, up and down, are still significantly undervalued, and we're just starting to play catch up before we had this very recent correction. So I think there's a lot of bargains out there right now and a lot of potential.
Well understood. Where would you say that the best value can be found if we're talking about producers only right now? Is it the large caps? Do you need to go down the size trail a little? Is it single asset producers? Where are you finding the most value right now?
I do not typically follow the big producers, but I think their value right now in the near term is exceptional. And I would stick with some of the bigger names, the Newmonts, the Agnico Eagles, and the like that I think are going to have near-term bumps as these earnings are released. The market was already starting to discount really great earnings before we had the setback in the metals prices. So these companies are down, 15% from their recent picks thereabouts. So I think that's a great place to be right now. But across the board, there's lots of opportunities. The developers, there are companies out there with really large resources. Some of them have economics wrapped around them. The economics haven't even been updated relative to current prices, metals prices. So I think those are great opportunities, near term or longer term. We've always thought of those kinds of companies as being takeout targets, and that's where you get the big write-ups, near term gains, kind of extraordinary gains as they get bought out by a major mining company. But we have yet to see that kind of M&A fever. But what we have seen are these companies, some of them even pre-resource, raising tremendous amounts of money. The new $10 million financing is $100 million financing for these kinds of companies. And that opens up the door to them developing these projects themselves, at least being the obvious other bidder for a major that wants to come in. So I think that even, buying these companies now exposes you to the potential of a near-term, takeout with some quick gains. But it's also backstopped by the fact that these companies can actually develop those projects in this kind of an environment. So long-term, you're protected on the downside. And then, even further down the food chain, the exploration stocks, there are some great companies out there and great projects, and they have the money now to actually drill and explore those projects appropriately. So we've been seeing some exceptional drill results over this season, and we will throughout the fall as the results continue to come in. So there are some great exploration plays out there as well.
Thank you for those insights, Brien. Recently, I had a chat with Rick Rule, who mentioned that he hasn't really partaken in a private placement in a while because the quality seems to be going down on his side. He's not able to find that value in private placements. Do you see that as well? And what do you think the health of the mining markets are currently?
Yeah, the mining markets are very healthy because everyone can raise money, or vast majority of companies can raise money. A lot of the money that's coming in is from outside the market. When you see companies that are pre-resource doing $100 million investments or placements, that money isn't necessarily coming from within this relatively tiny market. It's outside money coming in to get positions. So that means that it's not necessarily wrong money, but it's not the smartest value-oriented money like Rick Rule investor would be employing. Rick's the smartest guy in the industry. He is famous for being early in and early out. So he has criteria and standards that far exceed what you're going to get from these hedge funds and institutions, generalist institutions that are now coming into the market. So his hesitancy to buy placements is not surprising in the least, and in fact, something I would absolutely expect at this point in the market. It's not as easy to find the kind of deals now that were obvious 6 months ago, a year ago in this market. There are some, but those are more likely going to be new deals that are coming in from established management teams. So that's going to come, but it's going to be fewer and far between than what we saw 6 to 12 months ago.
Point well taken. How would you marry these two ideas? On the one hand, more capital now changing the same amount of opportunities. On the other hand, having an industry with, an aging investor base, aging workforce, also that has been starved for capital for years, if not decades at this point. How does that balance? And is this something that worries you, that we're now seeing outside capital flowing in?
No, I think it's to be expected. I think it's exciting. We have been conditioned, those of us within this sector, by years of underinvestment, by scraping by really, from a company standpoint, begging investors to toss a few pennies at them so they can keep the doors open and keep their projects in good standing. And now we're seeing a flood of money, which we might look at as stupid money coming in, dumb money coming in into the sector. But if you look at it from that dumb money's perspective, they're looking at a relatively tiny sector compared to the sectors they typically invest in, where the kinds of checks that they're used to writing can have inordinate impacts. And they're looking at a bigger picture, macro picture than, we're inside this bubble, so we don't really see it. As Don Cox was famous for saying, and I'm paraphrasing it, a sector is loved the least by those who know it the best. Because we're in this sector, we see the problems, we see the hazards, and sometimes it's better to know less because you're not hampered by all of that knowledge of the barriers that you face. So there's big money coming in here, and there's money that's used to writing $500 million, even $1 billion checks for AI, for Max 7, and the like, to build out AI data centers and the like. And they're looking at the fact that if they employ $1 billion into an entire mining frontier, an entire mining play, they could buy up every company in that play and secure decades of copper and gold supply. That hasn't happened yet, but I think that's on the horizon. And that would secure for a hedge fund that can bring that kind of money, into the sector. That would secure to them not just a seat at the table, but a strategic seat at the table going forward across a number of metals and elements. In the macro picture, the demand curve for copper, the demand curve for gold and silver on a monetary basis, for energy metals, battery metals, base metals, is extremely steep going forward because of all the supply constraints. And current, supply growth curves have no way of meeting that. So they're seeing that, and there's going to be big money coming into the sector, and I think we should welcome it. We're going to be cynical, we're going to be hesitant, but we need to at some point embrace a new reality.
Brien, this vision that you're describing of outside money coming in and really changing the game, is this married to the idea of a commodity supercycle where gold might be leading the pack and other commodities might follow to really have a decade-long bull market for all these commodities? Or should we look at all commodities separately and they're moving for different fundamental reasons?
No, I think it's the former. I think this is a commodity supercycle across the board. There are individual metals that have their own very bullish stories, but it's every one of them. Frankly, you can come up with a very compelling argument for every single really element in the periodic table virtually. The base metals have their own bullish story, broadly speaking, of supply constraints, investment shortages for decades and decades, and then real growth and demand curves going forward, where the supply cannot respond. The price signals can be delivered, but there's no way for new supply to come on rapidly to meet those demand curves. And coincidentally, at the same time, we have this commodity super cycle, particularly in the metals, in the base metals. We have a monetary super cycle for monetary metals, and that list is limited to gold and silver. So two big stories happening, simultaneously, and It is an opportunity-rich environment that I think is many years in the making and many years to run.
Excellent. That sounds like a very exciting time. I would also love to get your thoughts on silver for a second. Of course, we've heard a lot about supply and demand imbalance. Of course, also we are talking about a sector with incredibly inelastic supply. Is that a perfect storm for silver?
Yeah, it is. And, you mentioned the inelastic supply for silver. 70% of silver production is as a byproduct of other metals. And so these price signals being delivered from silver itself are muted in terms of bringing new supply on, or supply that can really move the needle. I have historically been really dubious of the industrial demand for silver, as having any real impact. The vast majority of silver's value is due to its history as money and its monetary cachet. So I've really dismissed that industrial demand. However, that industrial demand is going to have a very pronounced effect on the supply side of the silver story. Already is, and will have an increasing effect going forward. Over the next 5 years, industrial demand will take up every bit of mine supply from silver and more. So the monetary demand, which I think it really affects the price because it's demand on the margins, that will have a pronounced effect for silver over the years to come, because there's just not that much silver around to supply that demand. And then you have the fact that the rising gold price has moved without silver because of so much of it coming from central banks, which do not buy silver. Silver has a big catch-up ahead of it to get to its real inflation-adjusted levels relative to the gold price. So silver has outperformed gold in every long-term monetarily based bull market, all three of the previous ones. And I think, keeping it simple, it's going to do that again. And so I'm a big silver bug, and I think that a great way to play that, you can play it with silver itself, physical silver, paper representations of physical silver, and perhaps even leveraging those. But you can also play it through the silver mining equities across the food chain for that, from the producers down to the juniors, because they leverage silver and silver leverages gold. So you can stack leverage on top of leverage by getting involved in those really high-powered silver junior equities.
Really interesting points there. You referenced, of course, monetary demand for silver, and you also referenced that central banks do not really buy silver, at least except for Saudi Arabia and Russia, if I'm correct. What is this monetary demand coming from then? Is it just a different word for investor demand?
Yeah, it is a different word for investor demand, but I think, investor demand broadly defined, I think we're getting investor demand from institutions. But silver historically has also been a way for retail investors to play a monetary metals trend like we're seeing right now. They've actually been hesitant as well. The Western investors, or the U.S. retail investors, have been selling more than they've been buying. They've yet to be convinced of the long-term nature of this bull market. So, that so far has acted as a governor, a dampener of this trend. And when that shifts, that's a tremendous source of new demand that I think is going to come eventually. So yeah, we really haven't seen sovereign demand to any great degree in the silver market. The Saudi demand was through their sovereign wealth fund and not their central bank, but it's significant still. And I think we're going to perhaps see that at some point from central banks. I'm not sure. I'm a bit skeptical of that happening as well, but it is still a potential new source of demand in what is a tight and ever tightening market.
Definitely. When you referenced leveraged upon leverage, of course, the first thing that popped into my head was risk that's associated with leverage. But perhaps a silver miner is different compared to traditional leverage, like getting margin at a bank, because of course you get leverage to the exposure of a bull market. But if silver stays where it is, that's not significantly more risky compared to owning bullion.
Yeah, I think you'll see that the famous leverage that silver supplies in a bull market also equally applies in a bear market. So it outperforms gold on the way down as well as the way up. And I think leverage is leverage. It works both ways. There may be a little bit more friction in the silver equities, but they will leverage the price of silver, which leverages the price of gold in both directions. So yeah, you're right, there is risk. But then again, when you're leveraging in this market, as long as you're not on margin and have your entire investment portfolio at risk, you're betting on a macro trend that has a certain degree of certainty to it. If you look at the macro trend, if you look at the future of monetary debasement, currency debasement, it's something that is not going to reverse at any time soon, and in fact, it's likely to accelerate. So if we had a 1-year bear market in gold and silver, you're going to see tremendous losses from these levels in the leveraged investments, silver and silver mining stocks and mining equities as well. But that longer term trend will remain in place. In fact, we've seen bull markets or bear markets extend, or pauses in the bull market extend for 12, 18 months. We saw that in the mid 1970s. But the longer term trend will win out in the end. And, I think that's the safest thing anyone can bet on at this point.
All right, well understood. And talking about silver miners, you of course started hinting at it already. The miners, are they still attractively valued even compared to the current silver price, or is it mostly a bet on a continued increase in the price of silver?
Yeah, I think they are attractively priced. I think the producers have had really big moves. Some of the ones in our gold newsletter portfolio have multiplied, 4 or 5 times over. We haven't really seen that in the silver juniors as much, or the exploration plays. And their near-term potential reaction, or the kind of reaction we typically see in a rising silver price, like we've seen, is for those exploration development companies to go up 4 or 5 times. They've about doubled or tripled generally currently. I think they have a lot more upside. The last time we had a move like this was in the spring of 2016, where over a 6-month time frame, the silver juniors went up 4 to 5 times, but then that was cut short, and we went into multi-year kind of, one of those range trading sideways patterns. So that bull market was cut short. I think that the upside potential on some of these juniors that we see now that are in the exploration development stage are more like 8 to 10x. So they still offer tremendous potential from current levels.
What I would love to talk about, Brien, is really valuing or evaluating or assessing the value of a junior. How does one go about doing that?
Very difficult, if not impossible. As my friend Doug Casey popularized years ago, all of these things are burning matches. They have no assets. The only assets they have, whatever cash in the bank, it's their job to spend and to do away with. So they are hope. It's a hope and a prayer with these companies. So it takes a bit of experience to get an idea of what might be a good exploration play, and it's spreading your risk. It's spreading your risk across the food chain, across a number of companies. It's getting to know the management teams. It's getting to know basic geological concepts. understanding what is a good drill result, what's a good sampling result, how the evidence piles up. It's an inefficient sector. Something a point I pound home all the time is that this junior mining sector is inefficient. It's an inefficient market, and that's a feature. It's not a bug. It's something you can take advantage of. You can outwork other people. You can find the gems that the market leaves lying on the ground temporarily, where it values or potential or not recognized by the market. And each story is unique, and it has its own hooks, its own factors, its own avenues for advancement. And when it all comes together and a company is roughly undervalued relative to its peer group, companies that are exploring, that don't have a resource, that have a few drill holes or don't have a few drill holes, when it all comes together, you can take a flyer on these, but it's not the kind of a sector that you want to put a significant portion of your wealth in any particular story, because they are at bottom simply bets. One way that retail investors can try to put the odds better in their favor is by devoting time and money to the sector, going to conferences. There are a number of conferences out there where you can meet management teams and talk to them and ask them, what's their investment argument now, what could possibly go wrong, and what are their contingency plans. There are a few newsletters out there that are subscription-based newsletters where coverage is merit-based, that have good reputations that you can subscribe to and kind of cross-check these newsletter writers and see if some of the better ones are recommending the same companies. If that's the case, it's probably a good speculation or a decent speculation. So you can put in the work, you can put in a little money doing this, and it can be very rewarding in a market like we see now, where, as the old saying goes, when the wind blows, even the turkeys fly. When the losing investments don't lose that much or even gain, then that can dramatically enhance portfolio returns. So I do have a special report on our website, a free report, Investor's Guide to Gold and Silver, details all the best conferences in my view, all the best newsletters. Of course, mine are listed, but I do list all of our friendly competitors out there that I think have real value to offer.
Definitely. And I know you weren't necessarily alluding to your own conference, but I think this is a great moment to squeeze it in before I ask you some other questions on copper and some other commodities. Perhaps you can tell us a bit more about your conference that's coming up in a few days.
Yeah, it's the New Orleans Investment Conference. It is the longest running investment event in the world. This is our 51st annual event. And we have a reputation for bringing in a lot of the best speakers out there, virtually all of the best speakers in my mind, the best experts on geopolitics, macroeconomics, and yes, metals and mining. This year's roster has people like Matt Taibbi, who I think is the most important journalist of our generation, Mary Catherine Ham, a great political commentator, but wonderful macroeconomic and market experts like Danielle DiMartino Booth, Brent Johnson, George Gammon, Rick Rule, Peter St. Onge, Robert Kiyosaki, Peter Bookvar, Jim Bianco, Jim Urio, Adam Taggart, Peter Schiff, Mike Maloney. The list goes on and on and on. And as I tell people, you can find, 2 or 3, maybe even 4 of our speakers at other investment events, but you're not going to find 40 or more, which is what we offer. And it is, I think, the best value, especially in a market like this, where the returns on attending this event can be measured potentially in hundreds of times over. So we have a money-back guarantee that over the decades that we've offered, we've only refunded people's registration fees maybe 3 times. So that's an idea of the kind of value that we offer for the money. And it's in New Orleans. It's a lot of fun. It is and something that needs to be experienced to really understand why people come back year after year after year, and why they especially come back in a market environment like this.
Excellent. Thank you for taking us along there, Brien. I would love to squeeze in a couple more questions if you have the time.
Yeah, absolutely.
Awesome. Thank you. Regarding copper, we recently had a very tragic slippage of the Grasberg mine. Of course, quite a large producer of copper and gold. Is this going to have any substantial impact on the supply-demand dynamics of copper heading into the short, medium, and long term?
Yeah, it is. And I forget what the actual number is, but it's 3 to 5% of annual copper production from that one accident, I believe, if I remember correctly. But I think its real impact, or more important impact, is how it highlights the fragile supply chain for copper. We've talked a little bit about the supply constraints after decades of underinvestment, and the fact that it takes quite literally 30 years or so for a discovery to become a copper mine. So they typically span cycles before a new discovery gets into development. And this cycle is one that doesn't seem to be a short one. So we're not going to have a supply response very quickly to the kinds of demand surges, the surge in demand that we see coming. And that demand for copper is particularly important because you can't innovate around copper. Every other metal out there, you can mitigate the supply constraints to some degree by innovating around it. We see the components of lithium battery. You can emphasize or de-emphasize various commodities, metals that go into that, into the chemistry of a battery. But you can't innovate around copper, which is essential in putting that electricity to work through electrical windings and delivering that electricity through distribution networks and through the grid. So copper is, I think, the most dynamic non-monetary commodity story out there today. I think that every major copper deposit known, identified to date, will have to be developed, and that still will not be able to meet the demand curve ahead. And of course, those copper projects, not all of them will be developed because of political reasons and other constraints. So, yeah, I think copper is great. A great longer-term story. I don't think it's as dynamic as, generally speaking, as gold and silver. But I think if you take some of the better copper stories out there and develop a kind of a copper portfolio, even base metal portfolio of the best stories out there, and just set it and forget it and don't even think about it for a few years, you're going to be very, highly rewarded for your patience and foresight.
Excellent. I recently had a chat with Edward Bonner, who brought vanadium to my attention. Is that something that's on your radar? He thinks it's slowly becoming hated and is therefore slowly but surely becoming bullish on the material.
On which material? I'm sorry.
Vanadium.
Vanadium, yeah. Vanadium's long been a great story with not a lot of ways to play it. It has not captured the investor, marketplace because it is so small. It's been lumped in, and I think, frankly, will continue to be lumped into, a lot of the specialty metals, energy metals, and the like. The vanadium redox battery has tremendous potential, particularly on a utility scale going forward, and I think that's going to be one of the primary areas of demand for vanadium. I think vanadium suffers from its byproduct nature. It's a byproduct of other metals, so it's difficult to find primary vanadium projects out there, and there are very few companies out there, which from some standpoint helps the story because money coming into the sector has to be focused on those relatively few plays. By the same standpoint, if there's not a lot of ways to play it, it's typically that constrains the amount of money that comes into a sector to actually play that sector or play that theme. But I think longer term, again, it's one of those stories where it's a crucial element, a crucial metal that has severe supply constraints going forward. So it is an interesting sector to me. I played it a few ways over the many years, but currently don't have an allocation there. So frankly, I'd be interested in learning about some more of them.
Excellent. Well, we'll definitely go on my research list as well. I guess perhaps we can also talk about iron ore for a second. If you look at some of the producers like Vale, who is trading at a 10% plus dividend yield, and there's some others with even higher dividend yields. Is that a sector that's of interest to you, or are we too early in the cycle?
Yeah, it is of interest to me. I think it might be a bit early in the cycle. There's a lot of iron projects out there that have been undeveloped for economic reasons. So I think the supply response can be a little bit quicker there. Iron is interesting to me in that it also opens the door to some potential rare earth deposits and production from tailings and the like. I know that Cleveland Cliffs is starting to look at some rare earth projects as well. So longer term, I think it is, the base metals story is compelling to me across the board. I think that you would want to look at that through some individual plays as opposed to being a broader thematic play of getting into iron at this point.
Well understood. I hope you excuse me for trying to squeeze in one more commodity. Zinc is something I've been hearing a lot about recently, that it's being hated and it might be an interesting time to take up a position. What's your take?
Yeah, I think it is. I think it's a part of that broad spectrum of base metals and industrial metals and even a bit of energy metals where that comes into play. It's an unloved asset. It's not one of the glamours of the metals out there, but it is getting a price response, and I think we'll look at a price response for those very reasons that I mentioned earlier, supply constraints and the like, and growing demand. So yeah, I think it's longer term. I think there's a shortage of really large VMS projects, mining projects out there, and I think that's going to continue to have an impact on the supply-demand dynamic, and the demand curve is rising as well.
Brien Lundin, really appreciate it. Learned a lot today. Thank you so much for your insights and your time.
Well, I really appreciate the opportunity. I would encourage anyone involved in this sector to come to our conference. It's coming up very quickly. There's still time to get in. But prices are going to start rising very soon for our registration fees. So come on down to New Orleans, November 2nd to 5th. And goldnewsletter.com is where you can get our free investor's guide on investing in the sector.
Excellent. We'll make sure to put the links in the description. Thank you so much, Brien.
Thank you. Appreciate it.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.